Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tune in into this episode number 381. The title is Stop Worrying About Market Volatility. It's not worth it. Before we get started on today's episode, I always like to get the day started right two ways. The first one is by renewing our mind. And so this comes to us from Micah 6:8. He has shown you, O mortal, what is good. And what does the Lord require of you? To act justly, to love mercy, and to walk humbly with your God. I thought the dryer was shrinking my clothes. Turns out it was the refrigerator. In 2008, a couple had called my office asking for an appointment. We were in the midst of the financial crisis, and they were worried about their financial future. They wanted an appointment as soon as possible, and so we moved things around to get them in the very next day. When the time came for their appointment, they were a no-show. The next day, the wife called to apologize. She said that her husband was under so much stress that they had to take him to the emergency room at the hospital. He recovered physically from that stressful time. And of course, it's easy to look back at the financial crisis in the rearview mirror and see that it turned out okay. One of the most important things I've learned over the years working in the investment and financial planning field is that market volatility is a given. It doesn't matter what the market's doing today, tomorrow, or even next week. What matters is where the market is at the end of your time horizon. So if you're worried about market volatility, my advice to you is to stop worrying about it and to focus on the things that you can control, like living below your means, investing in a diversified mix of assets. The market's going to take care of itself. I like this quote by Epictetus. Wealth consists not in having great possessions, but in having few wants. Remember, I'm going to have show notes, links, articles, and resources available for your reading pleasure at soundretirementplanning.com. Just click on episode 381 if you want to do a deep dive on anything we talk about today. The stock market volatility is a buying opportunity for younger investors. If you're 50 years old or younger and you have 10 or 15 more years before you retire, this is one of the best buying opportunities in the last 10 years. So don't sit on the sidelines. However, volatility can be frightening to those who are approaching retirement or those who have recently retired. But there are ways to deal with it. And in today's podcast episode, we're going to explore why we're experiencing stock market volatility, how different asset classes are performing so far this year, and a few ideas for how to deal with stock market volatility, especially in the context of your financial plan, as well as opportunities to capture in times like these. Here are a few of the items causing the current market turmoil. Number one, we have rising interest rates. We have worldwide geopolitical turmoil with Russia invading Ukraine and China threatening Taiwan. We have seen oil prices and commodities spike, in part as a result of this geopolitical turmoil, but also as a result of President Biden's energy policy. We've just emerged from a global pandemic. We have supply shortages as a result of the global pandemic. The Great Resignation caused manpower shortages, which turned into employers increasing wages to entice people back to work. We have continued to pump massive stimulus spending into the system, which is a root cause of inflation. And I just recently read that now we're talking about forgiving student loan debt, which is just another form of stimulus, which will continue to spur more inflation. So let's look at how asset classes have been performing year to date. Stocks, as measured by the S&P 500, are down more than 18% year to date. Bonds, 10-year treasuries this year started out at 1.7%. Now they're up to 2.8%. I looked at a popular ETF that tracks 7 to 10-year treasury bonds, and that ETF is down 8.86% year to date. Now, when we talk about the S&P 500 being down 18%, almost 20% year to date, I do think it's important that you keep in mind that last year the S&P 500 was up more than 28%. Bitcoin started the year at 47,000. Now it's down to 29,000. It's down almost 38% so far year to date. And inflation's 8.5%. So if you have money sitting in the bank, you're losing purchasing power to inflation. To be fair, stocks were up last year and now they have come down. The ups and downs are to be expected in the stock market. Last year, our clients were dissatisfied with their low-risk money not earning enough. This year, they sure love those low-risk positions, but they're more concerned about the higher-risk assets declining. This is almost like gravity. What goes up comes back down, and the positions that don't go way down usually don't go up by very much. This is precisely why we're diversified. The greatest risk to investing success is not what the market does. It is what you do when the market does not do what you want it to. Amid the market storm, it's okay to be scared. But how you respond is the difference between a successful versus an unsuccessful investor. And you have a very important choice to make in times like these. You can choose to be fearful, or you can choose to be courageous. Courage and discipline are two of the most important qualities required for investing success in the long term. Chasing after temporary safety could result in long-term insecurity. Now, I found a couple of quotes about stock market volatility that I thought you might enjoy. This one's from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Charles Schwab says, use stock market volatility as an opportunity to review your investment strategy and make sure you're still comfortable with the risk you're taking. Rob Arnott says, in investing, what is comfortable is rarely profitable. Jim Cramer reminds us that the stock market is a manic depressive. George Soros says volatility is not a risk for the stock market. It's an opportunity. And of course, one of my favorites, Jack Bogle, says, my advice is typical. Diversify, focus on low costs, and invest for the long term. Don't speculate, and don't be distracted by market volatility. We are currently experiencing a market correction, and we're just about to be into a bear market. A market correction is a stock market decline of at least 10% from a stock's most recent high, whereas a bear market is a prolonged market correction where stock prices fall 20% or more from their peak. Corrections are a normal part of the stock market cycle and occur when stock prices get ahead of themselves and become overvalued. Corrections usually happen after a period of strong bullishness when stock prices have risen too quickly and become unsustainable. While stock market corrections can be scary, it's important to remember that they're a normal and healthy part of the stock market cycle. Corrections provide an opportunity for investors to buy stocks at a discounted price. They also serve to reset stock prices so that they're more in line with our underlying fundamentals. On average, stock market corrections occur about once every 2 years. However, the frequency of the corrections can vary depending on the overall health of the stock market and the economy. In recent years, stock market corrections have been relatively rare, and this is due in part to the strong bull market, falling interest rates, quantitative easing, and the federal stimulus that's been in place since 2009. If you're concerned about stock market volatility, there are a few things you can do to protect your portfolio as you prepare for retirement. Of course, one is to diversify your investments across different asset classes, and this will help mitigate the risk of losses in one particular asset class. Another is to have a healthy mix of stocks and bonds. Bonds tend to be less volatile than stocks and can provide stability during a market correction. If you're about to retire, you can create buckets and have your money diversified across time segments. The money you need in the short term is low risk, while the money you don't need for 10 years or more can be invested more aggressively. Having short-term money that is lower risk allows you to weather the storm, stay the course, and avoid selling at the wrong time. Investing is not gambling. The stock market is a way for all of us to invest in the businesses that are building the future of tomorrow. When we invest, we become owners of these businesses. Some of these businesses will fail and some will succeed, but unless there's nuclear war and we destroy humanity, the prospects that smart, motivated people will continue to invent to find better ways to do things looks very promising. Why would we want to envision a future that does not see continual improvement? We have no evidence to suggest that things will not continue to get better, but plenty of evidence that they have gotten much better over time. And if there is a nuclear war, well, I guess our money doesn't really matter at that point anyways. There's a lot in this world that we can't control. You can't control the stock market. You can't control interest rates. You can't control inflation. You can't control taxes. But there are things that you can control. You can create a strong spending plan. You can stop listening to the talking heads on social media. You can unsubscribe to the doomsday newsletters, most of which are just trying to sell you gold or crypto. You can revisit your financial plan. If you've been listening to Sound Retirement Radio for any time, you know that I like to say hope for the best and plan for the worst. What does your plan show you? Given the current values of your accounts, will this short-term volatility negatively impact your 30-year retirement plan? It's too easy to get caught up in all of the current events without considering the context of how they will impact your specific situation. And this is why I'm so adamant that a solid financial strategy is not simply a matter of asset allocation. A plan provides clarity and confidence and allows you to live a life of freedom with less worry. Remember, good investors don't let short-term circumstances derail a good long-term plan, and people with a good long-term plan have a better short-term perspective. In times of stress, we want to do something, but sometimes the best thing to do is just stay the course. So let's look at a few things that you can do right now. Number one, consider rebalancing your portfolio. In today's market, rebalancing would most likely result in the sale of bonds and the purchase of equities. It's the polar opposite of what our emotions desire. In times such as these, most individuals want more security. However, rebalancing will frequently necessitate selling high and buying low. What's low right now? Well, stocks are low, and your bonds have probably held up better in this time. If you want more information on the value of rebalancing, go back and listen to episode number 341. The title is called Buy Low and Sell High. The next thing you can do is tax loss harvesting. Tax loss harvesting is a technique for lowering your taxable income. Most of the people that we serve like the idea of paying less money in taxes. The strategy works by selling investments at a loss, which can then offset capital gains you make elsewhere in your portfolio. This is one strategy to lower your overall tax burden. If you do not have any capital gains to offset the capital losses, you can reduce ordinary income and capture $3,000 of losses per year. If your net capital loss is more than $3,000, you can carry the loss forward to future years. Having these accumulated losses can help offset future capital gains, and in years when you don't have a capital gain, you can take $3,000 to help reduce taxes on ordinary income. The next thing you want to be thinking about is Roth conversions. Because the value of your IRA has likely declined in value, this may be a time to consider converting some or all of your IRA to a Roth IRA. Remember, Roth IRA accounts can provide tax-free income in the future. They have no required minimum distribution requirements. Because they're tax-free, they can help reduce the taxation of your Social Security income. The Roth IRA provides a tax-free inheritance to your heirs. And if you want more information on Roth conversions, go back and listen to podcast episode number 377. The title is Roth Conversions. A good idea? When it comes to investing, our emotions are our enemy. Our emotions trick us to buy things when they're going up and convince us to sell things when they're going down. It's important to remember that stock market volatility is normal. Over the long term, the stock market has always gone up. A well-diversified portfolio will help you weather the storm. In retirement, diversifying your money across time segments helps you stay the course. Focus on what you can control. And lastly, have a plan and stick to the plan in the good times and the bad times.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.